Did you know that over $35 trillion worldwide is now invested under the ESG label, environmental, social, and governance? Globe showing Europe Africa money bag, but here's the shocking part. Critics say it might be the biggest investing fad of our time. Is ESG the future of ethical wealth building, or just clever marketing? Today, we'll uncover the real returns and hidden risks of ESG investing, and by the end, you'll know whether it deserves a spot in your portfolio. Welcome back to your channel name, where we break down complex finance topics into simple, actionable insights. Let's start with a quick story. Two friends, Aisha and David, started investing 5 years ago. Aisha focused on ESG funds, companies promising sustainability and good governance. David stuck to traditional index funds. Guess what? Their portfolios look very different today, but not for the reasons you might think. In this video, you'll learn what ESG investing actually means, beyond the buzzwords, the real numbers behind its performance, the opportunities and the dangers no one tells you about. Stick with me till the end and you'll have a clear, fact-based view on whether ESG is a smart long-term strategy or just a passing trend. First, let's set the stage. ESG stands for environmental, social, and governance, 3 pillars investors use to evaluate companies: environmental, impact on climate, emissions, renewable energy; social, labor practices, diversity, community impact; governance, board diversity, transparency, and ethical leadership. The concept isn't brand new. It traces back to socially responsible investing in the 1970s, but gained serious momentum after the 2015 Paris Climate Agreement. According to Morningstar, by 2025, ESG investments could surpass $50 trillion globally. That's nearly 1/3 of all managed assets. But numbers alone don't tell the full story. While some ESG funds have outperformed traditional markets in certain years, especially during renewable energy booms, others have lagged badly during oil and gas rallies. So, is ESG a true revolution or just a marketing goldmine for fund managers? Let's break it down. How ESG funds actually work. Here's the first key idea: ESG scoring is far from standardized. Different rating agencies, like MSCI and Sustainalytics, often score the same company very differently. For example, Tesla, hailed as an electric car pioneer, has received both high and surprisingly low ESG scores, depending on who's measuring. Why? Because while Tesla is great for the environment, critics highlight its governance controversies and worker-related issues. Case study: in 2022, the S&P 500 ESG index actually removed Tesla while keeping oil giants like ExxonMobil. So if you thought ESG funds are a simple, green-only investment, think again. They are complex, subjective, and sometimes politically charged. That means before investing, you must dig into how each fund defines ESG, not just trust the label. The real returns and money question: AAP Sok Rohi Honj, ESG Mine Paisa Kitna Banta Hai. How much money can you really make with ESG? Studies show mixed results. 2020 pandemic year, ESG funds outperformed traditional funds by an average of 4 to 6% because fossil fuel stocks plunged. 2022 energy crisis, oil and gas soared while many ESG funds underperformed. Take billionaire investor Larry Fink of BlackRock. He once called ESG the future of investing, but even he warns that short-term performance depends heavily on the economic cycle. Bottom line, ESG isn't automatically a high-return magic bullet. It can protect you from certain long-term risks, like climate regulations, but it's not immune to market swings. If you want stable returns, treat ESG as part of a diversified strategy, not your entire portfolio. The hidden risks and criticisms. Let's talk about the flip side. Greenwashing, companies exaggerating their eco-credentials, is one of the biggest risks. Some firms slap on the ESG label to attract investors without real action. Another risk? Political backlash. In the US, some states have even banned pension funds from considering ESG factors, arguing it's politically motivated. And here's a powerful analogy: think of ESG like a restaurant's organic label. Just because it says organic doesn't mean every ingredient is pure. You need to check the recipe yourself. So, the lesson: ESG requires active research and due diligence. Don't rely on a single score or fund description. What's next for ESG investing? By 2030, analysts predict the ESG market could surpass $80 trillion, especially as governments tighten climate policies and carbon taxes. But there are challenges ahead: stricter regulations to combat greenwashing, possible political divides creating uncertainty for ESG funds, technology-driven transparency tools, like blockchain, to track real impact. Here's a what-if scenario. What if AI-driven ESG scoring becomes the norm, providing real-time, tamper-proof ratings? It could transform how investors trust these funds, making ESG more credible than ever. Opportunity or obstacle? Time will tell, but the trend is impossible to ignore. So, is ESG investing fact or fad? The truth lies somewhere in between. ESG isn't just a passing buzzword, it reflects a global shift toward responsible capitalism. But it's no guarantee of outsized profits, and not every green fund is as ethical or profitable as it claims. Here's the takeaway: do your homework, diversify, and don't invest blindly just because something sounds ethical. If you found this breakdown valuable, hit like, subscribe, and turn on the notification bell so you never miss our deep dives into the world of smart investing. Speech balloon and tell us in the comments: do you invest in ESG funds, or do you think it's all hype? We'd love to hear your perspective.